Welcome everyone to the CFRA webinar, Is the U.S. Consumer Losing Steam? I'm Ken Leon, Director of Equity Research. With me today are our three presenters, Garrett Nelson, Vice President, covering the consumer discretionary and consumer staples sector. Garrett's going to give an overview from a sector perspective. Chris Kuiper, Vice President in the financial sector, covering consumer finance and real estate. And Camilla Januszewski, Equity Research Analyst, covering leading retailing companies and other companies within consumer discretionary. Today's agenda about CFRA, for those who have not been on webinars before. Then Garrett will touch upon consumer and sector outlook, Chris Kuiper on consumer finance and REITs, and Camilla on the retail outlook. We're really excited to present this webinar today, especially given market volatility, questions about the second half outlook of the economy. CFRA is one of the world's largest independent research firms, well recognized both in our fundamental and forensic research. We have over 90 years of innovation and growth. That is coming from both the fundamental research that goes back to S&P equity and fund research, and also the world-class institutional forensic accounting. Kind of the flywheel of our research is the ability of driving our fundamental research and forensic accounting to the output that we publish on Market Scope Advisor for customers, from market commentary, our dynamic sector and industry research, covering all the sectors in 68 industries. And today's a good example of that. Our unique holdings-based analysis and covering 1,500 global companies on a qualitative basis. The ability for our fundamental research to take advantage of CFRA's forensic research and risk mitigation, both from the standpoint of the diagnostic data that we get and the collaboration with professionals. On Market Scope Advisor, we also have model portfolios with cross assets, both ETF and mutual fund research. And every week we are generating enormous leading thematic research. These are investigative insights looking at our observations about companies and industries. Next. What we're most proud about is CFRA is an independent research firm. We invest 100% of our resources in providing research. Many independent research providers claim to be free of conflicts, but they are not. We do not have an asset management arm. We are here to deliver research, insight, and quality and performance for our clients' portfolios. And certainly, we feel that the ability for us to focus only on research means that we are a more agile firm and innovating every day. With that, let me turn the program over to Garrett to cover the consumer sector outlook.
Thanks,
Good morning,
Ken.
Garrett.
Good morning. One thing that's so important to understand about the U.S. economy that makes it different from a lot of other major economies around the world is that it's so consumption driven. So the pie chart on the left here shows the breakdown of U.S. real GDP last year between the four components of GDP, which, as we all learned in macroeconomics, equals C plus I plus G plus X minus M, or consumption plus investment plus government spending plus net exports. U.S. real GDP last year was about $19 trillion, and the consumption part of that equation is so large at about 70% of total U.S. GDP, as shown there in the blue in the pie chart on the left. We feel that the U.S. economy is really at a critical crossroads at this point in time, with consumers having pulled back on spending due to the pandemic, and we believe the rebound in US GDP will largely depend on consumer confidence and the overall health of the consumer. And because the US economy is by far the largest in the world, and it's still about 50% larger than China's economy, the second largest, the US consumer to a large extent holds the keys to a broader global economic recovery. The pie chart on the right shows the breakdown of that $13.3 trillion of personal consumption, the breakdown of which was about 64% services, 23% non-durable goods, and 13% durable goods in 2019. So this is why you often hear economists talk about the US economy as being very service-driven, and that's because industries such as banking, healthcare, large portions of technology, the legal profession, all those industries fall under that umbrella of services. Next, looking at some of the other key indicators of US consumer health, this shows GDP growth and employment. And obviously both have taken, about to look a whole lot worse when the next set of data releases comes out. But on GDP growth for Q2, many estimates are in the range of a 30 to 50% decline. In fact, if you look at the Atlanta Fed's GDP Now forecasting tool, it's currently estimating a drop in Q2 GDP of about 53%, and that's down from the 5% decline in GDP in Q1. And the chart on the right here shows the unemployment rate, which spiked to 14.7% in April. That was up from a 5-decade low of 3.5% just 2 months earlier. And of course, that's due to the shutdowns related to COVID-19. The May unemployment rate will actually be released tomorrow morning, and the consensus is for an unemployment rate of just under 20% in May. This next slide shows the weekly initial jobless claims, which has become a very highly anticipated weekly release every Thursday at 8:30 a.m. Eastern. And what it shows is that weekly unemployment filings hit a record high of 6.9 million in the week ending March 29th. And the number of filings has fallen each week since then, now has fallen for 9 consecutive weeks to 1.88 million in the week ending May 30th. And that data just came out a couple hours ago. The chart on the right here essentially tells the same story of massive job losses starting in late March and a catastrophic loss in April, with the greatest loss of jobs occurring in leisure and hospitality. And obviously behind each one of these job losses, there's a person, there's a family whose lives have been completely upended through no fault of their own. So it's a very devastating and sad situation, obviously. Next, looking at consumer confidence. In April, consumer confidence posted the largest month-to-month decline ever, as did the economic optimism index. But both showed a modest rebound in May, which was encouraging. The economic optimism index was still below the 50 level, which separates pessimism from optimism. But I think the takeaway is that both of these indicators appear to have bottomed with the April reading. And with consumers having now received their stimulus checks, and with the economy reopening and the stock market and housing market seeming to recover, we think the June readings will likely show a further rebound from May. Here on slide 12 are our outlooks for the 2 consumer sectors, consumer discretionary and consumer staples. Our recommended weighting right now is market weight on both. Obviously, consumer discretionary names tend to be higher growth, they're more cyclical, they also have lower dividend yields and higher betas, and have lower leverage ratios. Higher leverage ratios. And that's the group that's really had an enormous rebound since the market bottomed in mid to late March. In a minute, Camilla will have a lot more to say about the discretionary names and the retail stocks, which make up such a huge portion of that sector. But conversely, the consumer staples tend to be larger companies on average. They're more defensive, they're more value oriented, they pay generous dividends, they have lower betas, have lower leverage ratios on average. And consumer staples really outperformed in the first few weeks of March, but since then, the discretionary names have had all the momentum, with the S&P 500 having just posted the largest rally in a 50-day trading period in history. The S&P 500 now up 38% from the bottom on March 23rd. Moving on, key metrics to understanding the consumer sectors here on slide 13. And I'll have a slide or two on each of these bullet points coming up next, where we'll take a closer look at each metric and implications for both consumer discretionary and consumer staples and the various sub-industries within each sector. But we'll look at earnings stability, then we'll look at performance and valuation. We will look at betas for each sector, dividend yield and sustainability, leverage, financial leverage, and historic share price performance, where we look at the past two recessions and how each of these sectors performed, and also the various sub-industries within each. So we'll look back at 2008 and also the 2001-2002 period. First, looking at performance on slide 14, not surprisingly, consumer discretionary stocks have outperformed the broader market over the past decade, and have outperformed consumer staples names even more so. And the magnitude of the outperformance of consumer discretionary has really been pretty remarkable, as you can see from this chart. And that's exactly what one would expect because the bull market that we've been in, which officially came to an end earlier this year, but after a record long run of almost 11 years, consumer discretionary names performed very well. Next, if we look at valuation, the consumer discretionary sector is currently trading at huge premiums to both the S&P and its median multiple over the last decade. So how large are those premiums? Well, 37% above the S&P's current PE multiple and 58% above the sector's median PE of around 24 times over the past decade. And if you look at consumer staples, that sector is currently trading at a discount to the S&P of about 8%, although it's trading at a premium to its own 10-year historic median PE of about 14%. But as you can, as you can see here, consumer discretionary stocks are trading at their highest PE multiple in a decade on consensus estimates over the next 12 months, about 38 times earnings. This was as of May 22nd, and consumer staples are comparatively trading at much more inexpensive multiples. Moving on to some of the other metrics, we think beta is very important to understanding these two sectors and how the equities might perform in the future and how they've historically performed in the past. Most of you on the call are probably familiar with the concept of beta, but if not, it's a measure of a stock's volatility in relation to the overall market. For example, the broader market, the S&P 500 has a beta of 1. A stock that historically has moved up or down by twice the percentage of the S&P has a beta of 2. And conversely, a stock that has moved up or down by half as much as the overall market has a beta of 0.5. So this slide shows the 5-year average betas of the different sub-industries within consumer discretionary and consumer staples. And the key point is that the average beta of a consumer discretionary stock is 1.36, which is more than double the average beta of a consumer staples name, which is 0.66. On slide 17, this shows the average dividend yields currently broken out by sub-industry, with the consumer discretionary sub-industries on the left and the consumer staples sub-industries on the right. And as you can see, the average dividend yield for the staples names is triple the dividend yield of the discretionary names. So about 3% versus 0.9% for discretionary, and also well above the average yield of an S&P 500 stock of 2%. So staples are much higher yielding names. Next, looking at balance sheet leverage, in terms of net debt to trailing 12-month EBITDA, the average leverage ratio of consumer discretionary names is about 32 basis points higher than consumer staples. And remember, this looks at trailing 12-month EBITDA. So we think if we were to look at estimated EBITDA on a future 12 months, on a next 12 months basis, we think the gap would be a lot larger because of the drop in discretionary retail spending that we're seeing, and the fact that the cash flows of most consumer discretionary companies just aren't as stable and recession resistant as companies in the consumer staples sector, which is really dominated by such large cap names as Procter & Gamble, Coke, PepsiCo, Walmart, Costco, Philip Morris, General Mills, Clorox, Colgate, Palmolive, et cetera. And those companies produce products that are more essential and have much greater inelasticity of demand. Here on slide 19 is another leverage ratio metric, and the takeaway is that consumer discretionary names also have higher net debt to cap ratios than consumer staples, and you can see the average ratios by sub-industry here, but we would say that we consider net debt to EBITDA a more important leverage ratio. Next slide, let's look at the share price performance of both sectors during the last two recessions. So this slide shows the performance of consumer discretionary names during the year 2008, and also during the 24-month period in 2001 and 2002. And as you can see, consumer discretionary equity performance was about in line with the S&P during the 2008 recession, but the sector outperformed the S&P by a wide margin in 2001 and 2002. But we would note that a lot of that outperformance was because the sector was starting to rebound by the second half of 2002, as the economy had really started to emerge from recession by that time. Next slide, let's look at how consumer staples performed during these periods. And as one would expect, due to their low beta, more defensive nature, they outperformed the S&P by a wide margin during both recessions. And in 2001, 2002, the outperformance was extraordinary, but I should note that there were a few outliers in that drove that in the personal products and agricultural products sub-industries that kind of skewed the performance. But even if you strip out those few outliers, the sector still posted very strong double-digit gains on average, way ahead of the S&P 500's 33% decline. And finally, here are some names that we're bullish on and some that we're bearish on across the two sectors. Bullish, we like the three soft drink names. We like Walmart and Costco in the hypermarkets and supercenters category. And we also like Philip Morris in tobacco. On the bearish side, on the right, all these names are in consumer discretionary. The automobile manufacturers, the two companies shown here under home furnishings, and Whirlpool in the household appliances sub-industry. So I'll leave it there, and you can pull up our full stock reports and find those on MSA. And with that, I will hand it off to Chris Kuiper. Thanks very much.
Great, thanks, Garrett. As Ken mentioned at the beginning, my name is Chris Kuiper. I cover the consumer finance companies. These are largely the pure play credit card companies that I'll be talking about. And then I cover a number of REITs, and I'll be speaking about two REIT industries in particular, retail REITs and industrial REITs. But first, I'd like to start with the narrative we heard around the consumer for the consumer finance companies in 2018, 2019, and even going into 2020. And what we heard from a lot of the credit card operators and consumer lenders was the consumer is in great shape. And one thing they kept pointing to was consumer leverage is at all-time lows. The consumer delevered after the housing bust and has stayed delevered. And if you look at the household debt service ratio here, you can see why many people would think that. It is true that from 2008 to 2009, we saw big deleverage, and then we saw continued leverage, even though the economic cycle became quite lengthy in our opinion. But if you look at the next slide, we think you have to dig a little beneath this number. And that household debt service ratio is actually made up of two different ratios that are then added together. It's made up of the mortgage debt service ratio, so all mortgage debt as a percent of your disposable income, and then your consumer debt as a percent of disposable income. And consumer debt here is auto loans, credit card debt, and student loan debt. So even just looking at this, you can see what's really driving this, and it's the mortgage debt service ratio, as a lot of consumers shed their mortgage after the housing crisis, understandably. They did deleverage on a consumer basis, but in 2013 to 2014, that started going back up, and it's really been rising ever since. So another thing you can look at in this next slide here is, instead of just the percent of disposable income that's on a payment basis, you can look at how much debt people have taken on total as a percent of their disposable income. So this isn't monthly payments, but this is just total debt. And here you can see, again, mortgage debt has declined, definitely deleveraged there. But consumer debt, even though, again, it did decline a little in 08-09 with the recession, it held steady, it's been on its way up, and it's actually at all-time highs. So consumers have more consumer debt than ever before. And this isn't just a total number, because that's going to increase with the population, but this is scaled to total disposable income. Now, you may be wondering with some of these slides, how is mortgage debt only 4 or 5% of people's consumer debt, or how are these ratios so low? And I'll touch on this a little bit later, but these are aggregate numbers. This is not a household level survey. So actually high income people or people who are in the upper income brackets are going to be skewing that number better than what it actually is. If we go to the next slide here, another clue that we were looking at with this cycle in consumer debt was change in personal interest payments, so year-over-year change, versus the change in their real disposable income. And you can see with the last two recessions, personal income interest payments spiked to 15% or more year-over-year change right before the recession. So it far outpaces that 4 to 5% real disposable personal income growth, and then it plunges with the recession. So in 2019, we started becoming worried as we saw personal interest payments once again outpacing people's personal income growth. So their interest payments on especially consumer debt is rising much faster than their income. And then we did see it plunge in 2019, and then certainly into 2020 here, this is through March, it's gone negative. So it'll be really interesting to see when the National Bureau of Economic Research does its official dating of when this recession started and ended, or when it will end. I would guess that they might actually say the recession started in late 2019 based on just looking at one of these indicators. If we go to the next slide here, just giving a big summary of this. So headline figures said, consumers significant deleveraged after 2008. That was true on a total debt service basis, but if you dig beneath this, it was really all driven by the shedding of mortgage debt and the lower interest rates on that mortgage debt. What's interesting is that mortgage debt for your house is debt, but if someone sells their house and then starts renting, well, rent is not debt, but it still takes up a similar amount of cash flow. If I'm paying $1,000 a month to my mortgage, or if I'm paying $1,000 a month in rent, that's still $1,000 cash out of pocket. So consumers aren't really better off from a cash flow perspective, even though they've shed a lot of this mortgage debt. The other thing to note is that interest rates on mortgages have declined. You can see the chart at the right there. Interest rates usually follow, for mortgages, the federal funds rate. That's gone down as the Fed cut rates, but credit card rates have stayed stubbornly high. Excuse me. So this is also going to affect consumers, especially in that middle bracket that have a lot of consumer debt. And then, as I mentioned, these metrics are all positively skewed by high income households, especially the households that have seen the most robust recovery in their wages since 2008. Turning to the next slide, what does this mean for consumer finance companies? These were all things leading up, but they're not good timing indicators to the cycle. So for a little better timing indicator, one thing we like to look at are extremes in different sentiments or some of the other metrics. So consumer sentiment was hitting highs again. That became an extreme in late 2019. And then initial unemployment claims, which Garrett showed you before. I specifically made this chart, not the latest, so it wouldn't get way out of whack with the unprecedented number of claims, but this goes through the end of 2019. And when we were sitting in late 2019, changing our fundamental stance to negative for these consumer finance companies, we did so with the help of this as a timing indicator, saying, look, it's possible initial unemployment claims can go lower, but if you look at the chart, this is usually in an uptrend or a downtrend. And the probability that it's going to go lower than a 50+ year low is pretty slim. So again, as investors, we just need to try to put the odds in our favor. We can't time it perfectly, but we said this is showing us we're at a much later point in the cycle and it's time to start getting more cautious. Obviously, we couldn't have predicted coronavirus, but that was certainly the snowflake that caused the avalanche to fall here. The other reason we looked at initial unemployment claims is we've run a lot of these macro claims through just simple regression models. And the initial unemployment claim is the only one that we found to really be a leading indicator to things like net charge-offs, delinquencies. If you look at the unemployment rate itself, that's a lagging indicator. Once that's up, it's already too late most of the time. Turning to the next slide, what else does this mean for consumer finance companies? Well, obviously, delinquencies and charge-offs are going to rise. We saw auto severely delinquent 90+ day balances, the chart on the right there, they were actually creeping above levels set in 08, 09, 010. And this was before, this goes through Q1 of 2020. So it's really just capturing that very first 2 weeks of the coronavirus. It was already elevated. Credit card, it actually surprised us how benign credit card has stayed. But a few things that are making these things look low is every credit card company has introduced a forbearance program. So if you call into your credit card company, you can get a delayed payment, no late fees, no minimum payment due, but obviously the interest will still accrue. So that's going to keep delinquencies looking low because they're not going to count them as delinquent yet. So we think this is going to rise not only in Q2, but could potentially rise Q3, Q4 yet. Turning to the next slide, what else does this mean for consumer finance companies? We think the market's sending a clear signal about credit risk. Here I just plotted year-to-date performance of all of the consumer finance companies, so the credit card providers, plus all the payment companies. So some credit card companies like American Express operate a payment network, but they're also the issuing bank that provides the loans. Discover is this way as well, a closed loop system. But the payment companies, they just merely facilitate payments. They don't make any loans. So that's your MasterCard, Visa, Square, PayPal. They have a little credit risk here and there as they advance some loans now, but much less than the other providers. And so just plotting this year to date, lo and behold, it created a perfect bifurcation. All the payment companies with little credit risk are outperforming at the top, and all the consumer finance companies with much more credit risk are performing at the bottom and remain depressed. So clear signal here that already the market's paying attention to credit risk, and we think that's going to be a big factor through the rest of the year. Turning to the next slide here, the other thing we want to highlight from these companies is we think that investors and management are underappreciating the severity of this macro situation. We heard a lot of talk about a V-shaped recovery, which we were skeptical at, and now it seems like the market and investors are coming around saying, yeah, this probably isn't going to be V-shaped. These are just quotes, pretty much verbatim from the transcripts or the earnings calls, what these companies are thinking about in terms of macro statistics and models. And they're all looking at peak unemployment in Q2 of 9, maybe 10% at the most. And then it's going to recover through 2021, maybe 2022. But if you look at the chart at the right, we hit peak unemployment of 10% in the last crisis. And it took at least 6 or 7 years to get back down to that 4%. So we think similarly, it's going to be a lot longer than what management of these companies are currently predicting. All right, the next slide, we're going to turn now to REITs, specifically retail REITs. What we want to look at here is, retail REITs are one big group, but within that group, there's really 3 main categories, and they're not all going to be equally affected by the slowdown in consumer spending and COVID-19. Enclosed shopping malls, I could say a lot here, but we were bearish before coronavirus. We've been bearish for a few years just because e-commerce is taking such a big bite out of them. And it's also just a change in consumer taste. People don't like shopping at the malls as they did before, especially department stores. Department stores have been on a decline for actually a couple decades now, if you look at percentage of sales. So we think COVID-19 could really just be the final nail in the coffin for some of these, talking, viable concern here, especially as a lot of these malls have had to lever up going into this. And I'll talk about that in the next slide. Shopping centers here, they've pretty much borne the brunt of the slowdown and the retail disruption in 2017 and 18. They'll probably muddle along, and those that have a grocery center or something like that anchoring it will do a lot better just because they're going to get that traffic and that necessity buying. And then the one we're most positive on is freestanding, or sometimes referred to as triple net lease, where the tenant pays all of the maintenance, real estate, insurance, all of those other expenses. It's just passed through to them, hence the triple net lease. They're not immune to the COVID-19 fallout. A lot of them still have exposure to movie theaters or restaurants or some of those services or experiential things. But as a whole, their tenants are a lot better credit quality, and they're going to have more necessity shopping like drugstores and gas stations. The next slide here, looking specifically at the malls for a moment, it's really just gone from bad to worse to, beyond belief for some of these of how bad it could get. Like I said, final nail in the coffin for some as store closures continue to accelerate. And then all of the malls pretty much still have very high exposure to these troubled department stores. Just a couple of weeks ago, we finally got the bankruptcy from JCPenney, and then Macy's continues to struggle and close more stores as well. And on the right, you can see the result of all this. This takes a big toll on their balance sheet as EBITDA declines, but then they also need to raise debt or capital to try to turn these department stores into something else. It takes a lot of money to reposition them, either to find a new large tenant or to break it up into smaller tenants. On the next slide here, turning to industrial REITs, retail disruption has been a big beneficiary for them before COVID even. This just gives you a bit of a landscape of the industrial REITs. The picture at the bottom here I included just to give you an idea of what we're talking about. We're not talking about factories or heavy industrial things. We're mostly talking about logistics centers, these big warehouses that are football field size. They have a large number of bays for trucks to drive into, and they're all involved in the warehousing of goods as well as the sorting and the logistics of the transportation of those goods. So the big beneficiary here for them has been e-commerce, more shopping online, which I'll talk about next. And you can see the 5-year chart there, highly or vastly outperforming their REIT counterparts there. So next slide, why are these retail or these industrial REITs doing so well? Well, I mentioned e-commerce is the big driver. Well, why is e-commerce such a big driver for them? We point to two 3x factors. So the first 3x factor is e-commerce is growing 3 times as fast as total retail sales. I know Camilla will talk about this as well. And the other 3x factor is e-commerce requires 3 times the amount of warehouse and logistics space. If you think of a typical big box store like your Best Buy or Bed Bath Beyond, they have a big store footprint where they can store a lot of the goods there. They can process the returns there. So as companies move more and more sales online, they have to do all of this in the warehouse, in these industrial REIT warehouses. People also want more selection when they shop online. Hopefully you have higher inventory turns, and then you have to allocate space to process all those returns. For apparels, this could be really high, as much as 30% of sales end up returned. The next slide here, just leaving you with our bullish and bearish stance on the different property types. We've grouped them by type just because there's the same thesis driving them. Industrial REITs, you see our top picks there. Pretty much bullish on all of them, especially those that have the e-commerce tenants. A lot of these have Amazon as their top tenant. Retail REITs, the only spot there we like are those triple net or those freestanding ones. And then bearish across the board on consumer finance, and then obviously all of the enclosed shopping mall REITs. With that, I'll turn it over to Camilla.
Thanks, Chris. Good morning, everyone. My name's Camilla, and I cover the apparel, retail, and leisure product space at CFRA. Today, I'll be touching on CFRA's retail outlook. Now, when you think of retail, we think the best place to start is March's retail sales report. Why March? Well, that's because that's when the figures were starting to be truly jaw-dropping. Now, you can see in the chart in front of you that retail sales fell 8.4% in March. That's from February. And to put that into historical perspective, the previous record was in the fall of 2008, when retail sales fell 4% for 2 consecutive months. In terms of outperformers and underperformers, the underperformers you can see are the more discretionary retailers, and then the outperformers are the essential retailers. Now, the essential retailers were the ones that were open because in mid-March is when the stay-at-home orders were implemented. Now, if you thought March's retail sales figures were bad, we all knew that April's would be a lot worse because people were quarantining for the full entire month. You can see in the chart that retail sales fell 16.4%, and that was versus expectations for 12.3%. In terms of outperformers, you can see it's the non-store retailers. And one category I'd like to draw attention to is actually the food and beverage stores, because some people in forecasts were actually expecting for the food and beverage stores to show continual increases. We actually didn't think so. How we kind of saw the consumer psychology switching in March to April is in March, you have this initial panic. No one really exactly understands what coronavirus is. So there's this huge stockpiling surge. And then this stockpiling later transitions to consumer psychology of penny pinching. And we think that speaks to the numbers seen here. Now, what's in for the rest of the year? We think that there's going to be continued struggles on consumer spending, and we're going to continue to see some sluggish figures, although we don't think anything is going to be as bad as what we saw in April. There are 2 surveys in front of you from Coresight Research that can draw some nice predictions as to how we think consumer behavior is going to change. On the left, you can see that even when stay-at-home orders are lifted, 2/3 of respondents, they expect to continue to avoid public places or change travel arrangements. And how is this going to go into the holiday season? Another survey by Coresight Research on the right, 54% of all respondents anticipate spending less this year than last, and 28% expect to spend a lot less. And this is because of the economic impact on the outbreak. Now, with all this talk about how consumer behavior is going to change, it's important to also look on the flip side as to how are these retailers going to adapt. I think the best place to start with that question is social distancing, because that's really become the buzzword in retail nowadays. And what social distancing entails, this is from what we've collected from retailers that have reported so far on the earnings transcripts or any press releases they put out. We've also looked at different countries like China and South Korea that have reopened and kind of what their protocols are. So what this means is a limited number of visitors, hand sanitizing stations, requirements to wear face masks, even gloves when touching merchandise. Some retailers aren't opening up their fitting rooms. And we think that some retailers are also going to widen aisles. Also, temperature checks. Right now, thermal cameras, they're broadly being used in China and South Korea. And they've also, to an extent, hit the US marketplace. There are unconfirmed reports that actually Amazon has purchased some, which I think is interesting. Also, with more and more people worried about catching the coronavirus, contactless payments are skyrocketing, and also virus tracking applications. We know as of right now that US former New York City Mayor Michael Bloomberg, he is right now developing 3 smartphone apps in New York. Also, Apple and Google, they've announced a joint contract tracing effort. Now, it's maybe in the early stages in the US, but it's already being used in China. The platforms WeChat and Alipay, they give a color-coded designation as to whether someone can leave their home. It also gives information about the health status and also the travel history. And there's also a QR code that can be scanned by governmental authorities. And there are actually checkpoints where these codes are scanned. And then last, buy online, pick up in store. It's definitely with the digital economy. Adobe Analytics had put out some pretty starking figures. There was an 87% year-over-year increase in the month of March, 208% increase year-over-year between April 1st and April 20th. It's a trend that's going to continue long-term. And that's a great transition to the next slide about e-commerce. As Chris had mentioned, we're truly witnessing an acceleration of a major secular growth trend. To put into perspective, you can see on the chart on the left, just in 2010, e-commerce was about 4.2% of total US retail sales. Pre-COVID, that's grown to 11.4%. Now, obviously, a lot of this has been driven by Amazon, where on the chart on the right, you can see Amazon's growing share. Now, on the next slide, I kind of want to detract from the e-commerce conversation and just underscore something that I don't think is really talked about enough. Now, we believe, and what we've been telling clients before we even heard of the word coronavirus, is that the US consumer was losing steam, before this word kind of even came to being. Now, why we thought that was different indicators we saw back in 2019, and you'll see a timeline on this slide. One of the first indicators, between August 2019 and October 2019, consumer confidence started declining sequentially. Now, that was partly because of the implemented tariffs and also concerns of how US-China trade tensions would develop. But then come the holiday season, consumers were also dialing back in discretionary categories, notably in the month of November, and we also saw signs that wage gains were easing. Now, come to the start of this year, January, core retail sales were unchanged, and then February, before coronavirus even hit the US, retail sales declined 0.5% from January, and that was the biggest drop in more than a year. How we see it is that coronavirus exacerbated retail woes that were already evident, and it's clearly indicated within retail the divide between the winners and the losers. On the next slide, you can see how much consumer discretionary has been disproportionately impacted by this pandemic. There was a surge of corporate borrowing in March, and you can see a sector breakdown on the left, and then by industry within consumer discretionary on the right. Now, we did also look at the April figures, and corporate borrowing did slow in April, but consumers still accounted for more than a third of the total borrowing. Now, with corporate borrowing also comes credit downgrades. So not surprisingly, as of April 7th, S&P Global Ratings downgraded the long-term credit rating of close to 200 consumer-related companies. And how this is going to develop long-term is we see a surge of bankruptcies. The filings, we believe, are going to start coming in the latter half of 2020 and then into 2021, with a disproportionate impact on smaller businesses, apparel, retail, and then also specialty stores. And then on the next several slides, this is a quantitative analysis that we did that looked at what retailers, including apparel and footwear manufacturers, are better positioned to navigate COVID-19 and which ones are not so well positioned. And some factors that we looked at were free cash flow to operating cash flow, cash burn, and then also net debt to EBITDA. And in terms of cash burn, just for a definition for some who might not know, we define it as the estimated number of days a retailer can operate without cutting costs or new sales. The data on the next slides is really just for you to have, and happy to answer any questions about it after this call. And then on this last slide, we look at the bullish and the bearish. So we're very bullish on the general merchandisers, also the off-price apparel retailers, notably TJX, which is really developing its e-commerce game, and then also leisure products. On the bearish side, Chris had also touched department stores we've been negative on for a very long time, and then also specialty stores with archaic business models. That's your Bed Bath Beyond, your Office Depot, your GameStop. The ones that have been very slow to adopt e-commerce are definitely going to be feeling the pain through this pandemic. And with that, I'll open it up for questions.
Thanks, Camilla. And we have time for ample questions. And one came in that's timely for your presentation, Camilla, which relates to how important are the urban centers and obviously the distress of what's happened in the last week related to, looting, store damage. Is there a way to kind of navigate through that? And possibly could this mean a further delay in a rebound for retailers?
Yeah, we believe that there is going to be a further delay in the rebound. There's been a lot of optimism about this reopening, but not just in the urban areas. If you're also starting to look at the suburbs, even this weekend, I know where I'm based, there was notification that they would be putting barriers and closing the stores this weekend because of possible looting. Great.
And more on the defensive side, Garrett, looking over to the consumer staples sector, is there one or two key industries that you think are more attractive than others, and why?
Sure, Ken. So we really like big box retail here. So the hypermarkets and supercenters sub-industry, we think, longer term on the other side of this pandemic, they're going to pick up market share from all the distress that's occurring across small businesses, and also the retailers levered to shopping malls such as department stores. But if you go back to that slide, I think it was 20 or 21, and if you look at, it was 21 actually, if you look at some of the sub-industries which were among the best performing in both 2008 and the 2001-2002 recession, the two that really stand out are household products and packaged food and meats. So they performed very well during both of those time periods. So if history is any guide, and of course there's no guarantee that it will be this time around, those historically, those two sub-industries have outperformed during recessions.
Great. Chris Kuiper, the industrial REITs have been phenomenal performers for a long time and highly correlated to consumer spending. One of the questions I have, Chris, is what happens if consumer spending drops or does not go back to normal, given the pace of building new facilities?
Yeah, so it is a big risk that these companies highlight in their 10Ks and on calls, that they are highly correlated or dependent on consumer spending. These aren't big industrial goods or commodities going through their warehouses. They're consumer goods, they're auto parts, things like that. So it is a concern, but we think you have to focus on the delta between that as well as the time frame. So even if consumer spending overall drops, we think e-commerce will continue to outpace and grow. And one thing I forgot to mention when I was talking about industrial REITs was with the whole COVID thing, it's really actually accelerated our thesis on industrial REITs. We think they'll continue to outperform because e-commerce is a multi-year trend that we still think is being underappreciated by investors. And the coronavirus could really cause a step change in that thesis, where people who previously were not shopping online or not doing a lot of shopping online were forced to during lockdown. And then they're going to realize some of the cost savings or the convenience or the time savings and all those other benefits. And if they've been doing it for a couple months during lockdown, it's now ingrained into their daily or weekly shopping patterns, and they'll continue that well after the economy reopens. So again, longer time frame, we're still bullish, even if in the shorter time frame you could see a bit of a drop.
Camilla, what retailing categories will fare better? And I'm also thinking of the sizable inventory in stores. So would it be a TJ Maxx, or who really benefits right now given the current environment?
Sure. Well, we highlighted the bull and bear slide on page 52, but I'd like to touch on some other retailing categories. First, computer and electronics, and then obviously Best Buy, we have a buy rating on. It's the incumbent in the space. Now from Best Buy, they did get a boost, the Q1, from work from home merchandise, kitchen essentials, gaming, and fitness. But we actually did an analysis that looked at how does consumer electronics fare through recessionary environments. And what we've found is that this is an industry that has had steady growth over the past 2 decades, including times of slowdown. And I think that goes against conventional wisdom that consumer electronics is discretionary, volatile, and cyclical. And then also another category, sporting goods. And then in that regard, the incumbent Dick's Sporting Goods, we also have a buy rating on, and they reported earlier this week. Similarly, Q1, and then also kind of going into the rest of this year, they're going to get a boost from elevated interest in fitness equipment as these gyms are closed. But we're also seeing pent-up demand for outdoor recreation. And we think that outdoor recreation is going to get bigger wallet share as these stay-at-home orders are lifted. That's everything from camping, hiking, canoeing, and there's a great seasonal backdrop for it.
Great. Garrett, just on the spending data, and we didn't speak about it, but what category would industries such as airline, travel, and restaurants fall under?
Yeah, that's a good question. So airline travel is considered a service, and restaurants are under the goods category, specifically non-durable goods.
Chris, credit card companies, they come, some of the most significant companies in the financial sector, and very often I cover the banks, we're looking at FICO scores. And is there a way to kind of look at these credit card companies and think about where there's a ranking to FICO scores, whether it's the current environment and previous recessions?
Yeah, so we've seen some people say, well, the credit card companies are in better shape this time around because they've got higher FICO score borrowers, which is true on some level, but a few caveats to that is, one, they often only release scores at origination when they do the underwriting, so you don't always see how the scores may be deteriorating in real time. The other thing we saw, especially out of Capital One, which we currently have a strong sell on, and this is partly the reason, they didn't release it in their earnings report, but once the 10Q came out, you could actually see that their domestic credit card business, they split it into FICO scores greater than 660 and 660 and below. And they actually accelerated that proportion, that mix, by 200 basis points from 33% at 660 or below up to 35% just from end of 2019 to end of Q1. So they started getting, leaning more on the subprime borrower right in Q1, right into this coronavirus. Also with their autos, they look at those in 3 buckets: greater than 660, 621 to 660, and 620 or below. And they accelerated their 620 or below by 100 basis points from 32% to 33%. So if anything, some of these lenders were reaching for more growth by dipping down into the lower FICO score tier.
Camilla, we look at the department stores and take the question of who's better positioned, perhaps not bankruptcy, but just a good operator or having a portfolio of real estate that they can monetize and boost their stocks. Who's best positioned?
Sure. So we have sales on all the department stores, and our quantitative analysis is on page 48. But for more qualitative analysis, as you mentioned, real estate's important. We like to look at real estate health. And then we also like to assess omni-channel capabilities. In terms of real estate, we like Kohl's. 95% of their portfolio is in freestanding or in strip centers. And then also, as Chris had noted in his presentation, we are more cautious on Macy's, which is more mall-based. And then in terms of omni-channel, I'd like to call out Nordstrom. It has the highest digital penetration in this space. Pre-COVID-19, it was at 33%.
Garrett did a great job on the sector view, and I want to go to your wheelhouse, which is really automotive. And is it too soon to kind of decipher what's happening in terms of the absence of fleet inventory like Hertz or Avis? And additionally, there's been strong promotions in the last few weeks and month, so that dealers are actually well below their normalized inventory levels. What do you think?
So for the US market, we're currently forecasting a 22% drop in auto sales volume in 2020. What's interesting is the May data just came out, and it showed auto sales were down 30% in May, which was actually a lot better than what most analysts and industry observers were expecting. So you had a little bit of a rally earlier this week when that data came out, but you know, so I think what that reflects is a lot of stimulus checks being received and some of the extremely lucrative incentives, you know, the 0% interest, 84-month loan, you know, those types of mechanisms are being used, and they're, you know, being used effectively with the May numbers coming in better than expected. But you know, we still think it's going to be a rough, you know, the rest of the year. You know, we're expecting improvement almost every month going forward, but you know, it's still, you know, automobiles are one of the most discretionary purchases someone can make, and so you know, how we see this playing out is we're more positive on the used car market relative to the new car market. We think there's just been so much damage to consumers that, you know, we don't expect new car sales to rebound to prior pre-COVID levels anytime soon.
Great. Well, I'm going to do rapid fire here because we're coming up to the hour. Camilla, this came in. Do you think Dillard's will file bankruptcy?
On our quantitative analysis on page 48, we actually ranked them above Kohl's and Nordstrom and Macy's and JCPenney. Dillard's, though, has the least developed omni-channel capabilities, which we think puts them in more pain for this pandemic. They're the only one that doesn't even have a mobile app. It's definitely a risk on the horizon, and we'll see how they come out of the pandemic.
Great. Last one for you, Chris Kuiper. Just looking again at the retail REITs, is there an opportunity for one to rebound? It's an attractive investment, or we've seen with the market retail REITs actually move up significantly on share price?
Yeah, I think they're moving up on a lot of the reopening talk, which is understandable, but the next shoe to fall will be to see really how much the consumer goes out and spends there. And everything we've kind of laid out in this presentation here says that it's going to be a tough road for them. So we remain cautious.
Great. Cassie, if we can go to slide 54. I want to thank everyone for joining us today and want to share with you upcoming webinars. June 17th, Playing Defense in a Volatile Market. A fascinating discussion in terms of investing in defense as well as federal IT services. And then on June 25th, consumer staples and the future of meat production, protein meats. It's an emerging growth area. We're excited to present these along with others. To gain more information, you can certainly visit on our website, as you can see here below. Most important, I want to thank you for your valuable time. We hope this was of benefit to you. Please stay safe and healthy. Thank you again.